Hello, guys and girls. Welcome back to the fourth episode of the comprehensive Smart Money Concepts course. Are you one of those traders who gets into a trade near a level of importance, or be it a peculiar chart formation, but the price goes against your trade, takes out your stop loss, and the next thing you see, the price reverses its direction and moves in the same direction as you have anticipated in the beginning? I have been there, and it's very frustrating. And if you are one of them, then this video is for you. This video will definitely change the outlook of how you look at the charts. In the previous episode, we have talked in detail about liquidity, its importance, and we have also discussed in detail as to how major liquidity functions and where to find them. So, if you haven't watched that video, please make sure to watch it right away because it will give you all the basic stuff that you need to know when it comes to the concept of liquidity. But just to brush things up, liquidity is generally known as the fuel in the market, which is usually a cluster of retailer orders. That is, it can be limit orders and stop loss orders, which, when taken out or swept, causes the market to usually reverse in the direction of the existing market trend with a strong momentum. This will usually result in a fake breakout of the previous high or the previous low, which can be in the form of deep wicks taking out retailer orders. This is called as liquidity grab or liquidity sweep. Now, market always moves from one area of liquidity to another. So when liquidity is taken, the market needs to generate liquidity in order to move, which means if liquidity isn't already there, it will be created. And we have also talked about buy side and sell side liquidity. Then we have discussed about major or external liquidity, which in short is the liquidity available at or near the major market structure, which includes the major swing highs and major swing lows. You will get a good idea on market structures if you watch my video on the same topic on episode 1 of this course. In addition to this, major liquidity can also be found at or near higher time frame supports and resistances, weekly or daily highs and lows, etc. Now, in the previous episode on liquidity, I have classified liquidity based on market structure as internal and external liquidity. But looking at a much broader perspective, we can categorize liquidity into four types, of which the later two of them are actually applicable to the previous two classifications. I will explain this right now. But first of all, the different types of liquidity classifications are external liquidity, internal liquidity, static liquidity, and dynamic liquidity. As mentioned just now, external liquidity is the liquidity that can be identified above a range high or a range low, previous high or a previous low, or swing high or swing low. Internal liquidity, on the other hand, is the liquidity created within a range high and range low, previous high and previous low, or a swing high or a swing low. Now, when it comes to static liquidity, this liquidity is created or it is identified at or near double bottoms or double tops, or simply near equal highs or equal lows. And finally, dynamic liquidity is actually identified as the liquidity which is associated with a trend line. So, this liquidity is created at both sides of a trend, that is, above and below a trend line. Now, you might have understood how the last two types of liquidity, namely the static and dynamic liquidity, are related to the first two types. It is simply the fact that trendline liquidity and liquidity associated with equal highs or lows, or simply the double tops and double bottoms, are observable in both major and minor structures in the market. Now, we will understand about internal liquidity, how to read it or how to spot it, and how retail people get trapped in these areas. As you may know, minor liquidity is the liquidity associated with the internal market structures. This means all the clusters of retail orders which are getting accumulated between the major market levels, like the major swing highs or the major swing lows, are known as internal liquidity. So you can anticipate a lot of retail stop losses and limit orders at or near these minor swing structures. In the screen, you can see a few structures. These are all common areas where you can spot internal liquidity. We will first understand each one of them and then take a few examples from real charts. This is not a very difficult topic to understand. All you need to do is to think how a retail trader will respond when provided with a particular situation in charts. So, all you have to do is to think like you always have as a retailer, And without much efforts, you will be able to identify where the minor liquidity is already available. In the first diagram, we can easily spot equal lows. So technically, we have two lows on the same price level, thereby forming a minor support level. It is also known as double bottoms. We have learned that double bottoms are reversal patterns, right? So what do you think a retail trader will do when he or she spots a double bottom pattern? It is very obvious that they will try to take a long trade either after a breakout above the neckline, or some might even take a long position from the support level connecting the lows. Now comes the important question: where will they set their stop losses? Almost all of them will place their stop losses somewhere below the support level. Now you can imagine that there will be a large cluster of stop loss orders lying below this support level. These are all stop loss orders set by the buyers who have taken a long position, and these stop losses are sell orders or sell side liquidity. But what exactly do you think this is? This, my friend, is retail liquidity that we have been searching for. Now, what happens next? Or what will be the outcome? The smart money will always look to buy at lower prices, and they will look to sell at higher valuations. They do not follow any strategy or patterns, but they take their positions based on liquidity. So, most often or not, they will look to tap into these areas of liquidity to execute their positions at the best possible valuations. Now, coming back to a discussion on double bottoms, the smart money or institutions will push the prices down and break below the equal lows or support level so as to absorb all the sell side liquidity. And once all the stop losses are absorbed or swept, the market usually reverses its direction and move higher. This is usually more frustrating for traders than hitting the stop losses, because usually such a move will impact a trader's psychology, and it will also question his analysis and learnings. So, in short, there is liquidity below equal lows or below the support level connecting the lows of the double bottom, which is actually a cluster of sell stop loss orders or sell side liquidity which gets tapped by the big institutions to buy at lower valuations. Now, the second diagram shows equal highs. It means that we have two high points on the same price level. This is also known as a double top pattern. Like a double bottom, this is also a common reversal pattern that you can find on charts. If you have clearly understood how liquidity and retailer mindsets works in case of a double bottom, then understanding the logic behind double tops or equal highs is just a piece of cake. Ask yourselves, what will a retailer do when they spot a double top pattern? They will try to take a short trade either after a breakdown below the neckline, or they might even sell when the price starts falling from the top resistance level connecting both the tops. Now, where will they set their stop losses? Most commonly, retailers will place their stop losses somewhere above the top resistance level. Now you can imagine that there will be a large cluster of stop losses lying above this resistance, and almost all these stop losses are placed by short sellers who sold from the resistance or neckline. So technically, this cluster of stop losses are buyback orders or buy side liquidity, and this is the liquidity that smart money is keen to tap into. So, what do you think will happen next? Smart money will always look to sell at higher valuations, and they will try to collect the retailer buy stop loss orders or the buy side liquidity which is clustered above the double top or the top resistance level. So, most often they will push the prices higher and break above the equal highs or resistance so as to absorb all the retail orders to sell their positions at the best possible prices. And once all the stop losses are grabbed or swept, the market will usually reverse its direction and move lower, which can be really heartbreaking. Now, if you have understood both these types of liquidity, then the next few types are going to be really easy. Yes, we are talking about support and resistance liquidity next. So, what happens in a support level? Think about it in terms of a retailer. What will be a retail participant's thought process? So, when price test a support level few times, we can anticipate two types of market participants around this area. The first group involves buyers who are looking to take a long position at or above the support level to take a reversal trade. The second group are sellers who are looking to profit from a breakdown below the support level. Now, how will both of these players act in this scenario? First up are the buyers. They are looking to take a long trade entry, so they will try to buy at or above the support level, and they will place either buy limit orders or market orders. Now comes the important question: where will they place their stop loss? They will set their stop loss somewhere below this support level, which is actually a sell order. And when it comes to short sellers, they are looking for a breakdown below the support level. So they will either place a sell limit order or a sell market order at or below the support level when the breakout happens. And these guys will set their stop loss somewhere above the support level, which is actually a buyback order. Now, as you can visualize, there are a large clusters of buy and sell orders getting accumulated above and below the support level. Or in other words, there is sell side liquidity or clusters of sell orders below the support, and buy side liquidity or clusters of buy orders above the support level. And this is a golden opportunity for the smart traders to capitalize on. So, what do you think will their action plan be? You might have seen and experienced this happening many times in the chart. The smart money will first push the price below the support level to break into the sell side liquidity so as to be able to execute their large buy order positions at the lowest price possible. This will result in retailer sell orders and sell stop losses being triggered. Now the buyer positions will automatically be exited when their stop losses gets hit, while the sellers are still in their trade and their buy stop losses are still active above the support level. Now once all the smart money orders are executed by the retail sell orders which was accumulated below the support, they will push the price higher. And what will happen now? Now all the buy stop orders which were set by the sellers will get triggered, and they will also be out from their trades. This will lead to the market moving higher strongly. This will in turn induce the FOMO traders to start buying and thereby pushing the markets even higher. This is a typical case of false breakout and liquidity grab in the market. And even now, a majority of retail traders are unaware of this smart money trap. The same action plan happens in the case of resistance levels also. Here also there are two players. There are sellers who look to take advantage of a reversal from the resistance level so as to initiate a short position at or below the resistance. They will set their stop losses somewhere above the resistance level. Then there are buyers who are looking to benefit from a breakout above the resistance so as to buy above the resistance. These guys will set their stop losses below the resistance in the event of a breakout. So there is buy side liquidity above the resistance and sell side liquidity below it. And as you might have guessed, the smart money will try to manipulate both these players. They will first push the price above the resistance so as to execute their sell orders at higher valuations by absorbing the buy orders or buy stop loss orders, thereby taking out the short sellers out of their trades. But the breakout buyers are still active in their trades and their stop loss orders are still live below the resistance level. Or, in other words, the sell side liquidity is still available below the resistance. And once all the large smart money positions are filled, they will push the prices lower, thereby absorbing the sell side liquidity and taking out the breakout buyers. This will cause the price to fall rapidly, which will encourage the FOMO participants to start selling and thereby causing the market to decline even lower. This is another typical case of false breakout associated with a liquidity grab. A similar approach is seen during consolidations, especially the rectangular ranges. When it comes to rectangle patterns, we have a bottom support level and a top resistance level. So, most often, the false breakout happens in the opposite direction of the market trend. For instance, if the market structure is bullish, then most probably we might see price absorbing the retail liquidity available below the bottom support level and then push higher to form a real breakout above the resistance level. On the contrary, if the market structure is bearish, then most probably we might see a false breakout above the top resistance level so as to absorb all the buy side liquidity, and then the price might move lower and form a real breakdown below the support level. Now, this analysis is not 100% accurate because we cannot predict the occurrence of a false breakout perfectly. Since there is liquidity available on both sides of support and resistance, it can lead to more than one fake outs. Or in some cases, there might not even be a fake out. Now let's talk about the next category of internal liquidity, which is the trend line liquidity. Now, trendline liquidity is one of the most common types of smart money manipulations that you can encounter on charts, especially when there is a predominant trend involved. Technically, there are two types of trend lines: uptrend lines and downtrend lines. Another important thing to keep in mind is that for a line to be considered as a trend line, there should be at least two touches on it. And to confirm a valid trend line, there needs to be at least three touches on it. Now, this concept is easy to understand if we compare it to support and resistance. So, consider the uptrend line as a support level for prices and downtrend line as a resistance level for prices. Now, it is easier to visualize the events better. So, let's start with an uptrend line. As I have mentioned, an uptrend line acts as a support for prices. So we can expect two types of participants waiting to take a position. There are buyers looking to go long from the support trend line. Then there are those short sellers searching for a breakdown below the support trend line. Thus, there lies buy side liquidity above the uptrend line and sell side liquidity below the trend line. This means most often both retail buyers and sellers stand to lose their stop losses. The big institutions will first push the prices down to break below the uptrend line. This means all the sell stop orders of buyers and sell limit orders of short sellers will be triggered. The smart money will try to absorb all the retail liquidity to ensure that their large buy positions are executed at the lowest prices possible. Now, only the short sellers are active in their positions with their buy stop losses live above the trend line. Once all the smart money orders are filled, they will take the prices higher, revisiting the buyback orders placed above the support trend line. By doing so, the short sellers will also be taken out of their positions once their stop losses are triggered. This will in turn push the prices higher. So you can see how both retail sellers and buyers are equally affected by such a manipulation. A similar scenario persists when it comes to downtrend lines also. There will be buy side liquidity above the resistance trend line and sell side liquidity below it. The smart money will create a false breakout above the trend line, sweeping all the buy side liquidity in order to execute their sell positions at the best possible valuation. And once all their orders are filled, they will reverse the prices to move lower, which then takes out the sell side liquidity, and then combine it with the new FOMO sellers coming in, the market will fall even more. Finally, there are people who look to trade prominent chart patterns like flag patterns, which unfortunately is yet another internal structure formation that is prone to liquidity manipulations. You might know about flag patterns, how it forms, and how to trade them. If you don't, you can watch it in my chart patterns course video. Basically, there are two types of flags: bullish flags and bearish flags. Let's start with the bullish flags first. Flags are continuation patterns, meaning that the possibility of the existing trend to continue is fairly high. When a bullish flag consolidation is spotted, the retail traders will look for a bullish breakout above the top resistance line. Now, majority of this group includes buyers who are looking to take a breakout trade, and they will usually set their stop losses below the bottom support level. This is the usual practice. Now, the manipulation happening here is very exciting. First, the smart money will create a small reaction above the top resistance level of the flag. This minor reaction above the resistance will induce a lot of former retailers to take the bait. That is, they will think it is a breakout. And these traders would rush in and place their buy market orders and buy limit orders above the resistance in order to buy, and they will in turn set their stop losses below the bottom support level. But most probably, this reaction would be a false breakout to trap the retailers into taking a trade. Now, the price would move lower and break below the bottom support level, where lies a large clusters of sell side liquidity, and these institutions will ensure that all their buy orders are executed at the lowest prices possible. Sweeping the sell side liquidity means that all the buy stop losses are triggered and they are taken out of their trades. Now, what happens afterwards? Quite clearly, the market will bounce back higher and this time creating a real breakout instead of a minor reaction. And once a strong breakout with high volume appears, more traders would join in and the prices would rise even higher. A similar scenario takes place in case of a bear flag. But here, instead of buyers, the FOMO sellers would get trapped. A bear flag, as you may already know, is a bearish continuation pattern. So most of the retailers would look for a breakdown of prices below the bottom support line so as to take a short trade position while setting the stop losses above the top resistance line. So the smart money will create a sudden price reaction below the support line, which will induce a lot of retailers to enter into short trades. This activity causes a lot of buy stop orders getting accumulated above the resistance line. This is actually buy side liquidity. And the market will create a false breakout and it will move higher to grab this liquidity in order for the smart money to execute their sell orders at higher prices. Now, almost all the buy stop loss orders above the resistance level will be triggered, and those traders will be taken out of their positions. And once all the smart money orders are executed, the market will once again reverse and move lower. And this time, the market will form a real breakdown below the flag support, to which more short sellers would respond by selling aggressively, and the market will fall even lower. Now, there are other patterns and other situations in the market where internal liquidity is available for the taking within the major structure. Some of them are symmetrical triangles, price channels, supply and demand zones, etc. But the ones that I have discussed here are the most important types, and it is more than enough to get a fair understanding as to where to find internal liquidity and how to find smart money traps associated with them. Now let's move on to a few quick examples of such internal liquidity manipulations in the real market conditions. Take a look at this chart. You can see price making equal lows. So clearly there is sell side liquidity below this level. And what happens next? As you can see, the market moves down and absorbs these clusters of orders, and then it reverses to go higher. Usually, when liquidity is absorbed, the price will move quite strongly. Moving on to example 2, what we have here is equal highs. And you know what that means. It means there is buy side liquidity available above this level. Now, the smart money are eager to manipulate or absorb these liquidity areas. And guess what happens? The price breaks into this liquidity area and sweeps out all the retailer orders above it. And then it moves down lower. This is a typical manipulation that you can find on charts on a regular basis. You can call it double tops or double bottoms also, but the logic remains the same. Now, example 3 is a support level within the major structure, and we have talked about how the manipulations takes place around a support level or a demand zone quite clearly. So there is buy side liquidity above it and sell side liquidity below it. And look what happens next. The market breaks below the support level, gets hold of the retailer stop losses, and then reverses and goes higher, taking out the buy side liquidity. This price manipulations affects both the players. Now, this is example number 4, which is a resistance level within the external structure. Here also, you can anticipate retailer orders stacking above and below the resistance. So there is buy side liquidity above the level and sell side liquidity below it. And as you can see, the price broke above the resistance level to sweep the buy side liquidity. And once it is done, the market reversed its direction. And in the process, it takes out the sell side liquidity and moved lower. Now look at this case. An internal uptrend line has formed within the major structure. From what we have learned, there are both types of orders available above and below this trend line. And look what happened here. The price broke below the trend line, thereby taking out the sell side liquidity, and then it did a sharp reversal and moved higher. Now, yet another example is of a downtrend line which formed within the major structure. Here, the price made a false move higher to grab the retailer liquidity and then reverse lower to continue in the major trend direction. The next example is one of a flag formation. This is a bullish flag formation. And as you can see, the price made a false breakout or reaction below the support level just to absorb the liquidity available in the form of stop losses. And then the price broke above the flag and moved higher. This is a similar example, but this is a bear flag formation. Here you can see the market took out the liquidity above the top resistance line, and then the price returned and broke below the lower support and continued to decline. In this manner, using this simple logic, you can spot innumerable liquidity manipulations in the charts. It could even be in the form of recognizable patterns that most retailers are keen to trade from. So go ahead and look for such manipulations and liquidity grabs in the charts, and also try to understand what happens next. You will clearly understand how the price movements are engineered in the markets once we have a discussion on a few more topics like order flow, order blocks, and inducements. We will continue this discussion in the upcoming episodes. Till then, keep learning, practice what you have learned, and backtest on the charts to solidify the concepts. If you have found this video useful, do make sure to give a thumbs up, share it with your friends and fellow traders. And if you're new to this channel or you haven't already subscribed, make sure to subscribe and also enable the bell notification so that you will never miss out when a new episode rolls out. Till then, see you.